Hi everyone, this is Ben Ryan of Hedgeye's Macro team here with macro and housing analyst Christian Drake. We're going to talk housing here for a few minutes. It's been quite a move in rates. Well, not quite a move relative to how it's been. You'll talk about that, but it's been a move here higher in rates in the last month and a half or so. I mean, what are you seeing with the housing stocks, with fundamental housing picture, and how should we contextualize this within other maybe recent or precedents in the past to kind of get a feel for how people should be positioned moving forward.
Right. So for housing investors, most of the focus has been on the rate move the last 3 weeks, and what does it mean for housing? I guess just to start here, to contextualize where we've been and where we are from a rate perspective, we have an affordability table here that we can pull up, and what you'll see is that in 2014, mortgage rates, the 30-year fixed mortgage rate averaged 4.21%. 2015 year to date, average is 3.84%. And inclusive of the recent moves, so last 3 weeks, we've seen rates go from 3.73% to 3.89% on the 30-year mortgage contract. So we're at 3.89% currently, and what that equates to is we're still below the last year's average, and we got about a 4% tailwind to affordability here currently, and you need to see rates move up another 20, 30 basis points before they'd even start to be negative from an affordability and price perspective on a year-over-year basis.
Right. I mean, when would you see, how long would that have to happen? This trend, if it continues, how many more months or how many more weeks until this really begins to eat into the fundamental tailwind in housing?
Okay, so from a fundamental perspective, it's what we did was how we contextualized it. We went back and looked at historical periods where you've seen rapid rate rise, and we said, all right, what's happened to home sales and what's happened to home price growth during those periods? And we have a chart here for this also. And there was 3 historical episodes where we've seen an expedited increase in rates. Back in 93, back in 98, and then most recently in 2013. In the first instance, you saw rates go up about 240 basis points in a 14-month period. Second instance, you saw rates increase, these are 30-year mortgage rates, increase 180 basis points in 19 months. And then this past taper tantrum instance, rates were up 120 basis points in 10 months. So average duration of 14 months, an average move of 180 basis points.
So that suggests, this suggests that we could have a long ways to go. I mean, what's the risk to the downside for home builder stocks, like the companies, home builder stocks companies that make up the ITB index?
Yep, so we used the S&P Home Builder Index as our proxy in looking at this historically, and what you found is the stocks are a lot more sensitive than the fundamentals are. So in these 3 periods we just profiled here, you saw negative absolute returns of 22%, negative 22% for home builders, and negative relative returns of 42%. So big underperformance, big downside if you think rates are going to increase significantly from here. So again, that's what we'd highlight. So rates have moved 16 basis points, inclusive of the last 3 weeks and the recent move we've seen. And home builders have underperformed to the tune of around 10%.
You said that the meetings you've gone into with institutional clients that have covered the housing sector for many years always revert back to the biggest question, which is what is your view on rates moving forward? So I guess we obviously have to have a view as a macro team about an intermediate to longer term direction for interest rates. So that's what you found, right?
Yeah. Well, we from the macro side, we think we're late cycle. We don't think either the growth or inflation outlook is going to support a serious or sustained attempt at policy normalization up to 3 to 4% Fed funds. So we think most of that is baked in. We've seen some of the carry trade unwind, and we've seen some of the price reflexivity play out in the bond market globally. We think most of that move is in. And again, if you think that rates are going to go up another 100 basis points, then you don't want to be long the home builders.
Right.
We've seen them underperform 10% over the last month. We think most of the negativity around the interest rate move is baked in at this point. we don't see another doubling in global yields from here, or another kind of expedited step function increase in the 10-year Treasury or mortgage rates over the very near term.
Right.
So, we think that we don't think it flows through the fundamentals. We think it's largely baked into the stocks. But again, if you think we're in for further rate increases over the next 12 months, the home builders underperform.
All right.
Traditionally.
There you have it. Thanks, Christian. Thanks everyone for tuning in. Hope to catch you back here in future segments.